Now, here when we turn to the U.S., we always want to start with the Fed, and just because it's really important when you're looking at inversions, when the yield curve inverts, what is going to happen with Fed fund policy. And this is a chart that we've mentioned in the past, but it's becoming more and more relevant only because it's what is the profitability of the Fed, and that's just the simplicity of what we're looking at. Because as the Fed is a buyer of treasuries, they're earning interest. And then they take that interest from the treasury, and then every so often they cycle that back to the treasury because they don't, again, they're a nonprofit organization for the most part, or at least they should be. And and so they just cycle that back at a steady piece, because now the Fed does pay out interest because all of these banks have to keep money within the Fed. They'll pay interest on that, but normally what they're earning from treasuries will offset what they're paying out. Now, because they have been selling treasuries, bringing in dollars, selling treasuries, because those rates have gone up from their own policies, and now that they're paying more to the other banks that are keeping liquidity on their balance sheet, they're now actually losing money. And I thought the Brooks Foundation had some good quotes on it, which I just wanted to touch on. So its liabilities consist primarily of currency outstanding, which of course pays no interest. Deposits of the U.S. Treasury, which also pay no interest, and reserve deposits of banks and repo borrowing from money market funds and other lenders, both of which do pay interest. Normally, the interest the Fed earns on its securities greatly exceeds the interest it pays to banks and money funds, and the Fed meets its expenses from the surplus and remits the rest to the Treasury because they have to fund themselves. So this is not a huge problem right now, but as rates stay elevated, this is going to be something to watch. Now, the Fed can always just print money to cover what it needs, but then that creates its own problem of, well, now you're doing QE in a different way, and that's why it becomes its underlying conundrum. So in response to the COVID, obviously, and not only just COVID, but also just in general with the use of QE, the large-scale purchases of Treasury securities and agency MBSs or mortgage-backed securities, both to support market function. Its securities portfolio grew from less than $4 trillion to $8.5 trillion between March 2020 and March 2022. Over the same period, currency expanded from 1.8 trillion to 2.3 trillion, and the Treasury count at the Fed rose from 0.4 to 0.6. Despite the more modest growth in the Fed's non-interest liabilities, the interest earnings of the Fed security holdings increased much more than the interest paid. And the Fed's remittance to the Treasury rose from $55 billion in 2019 to $87 billion in 2020 and $109 billion in 2021. If the Fed booked a loss in a given year, it would have no profits to remit to the Treasury. Under the Fed's accounting rules, it would then accumulate a deferred asset equal to its cumulative loss. Once the Fed returned to profitability, it would retain profits to pay down the deferred asset. Only once the deferred asset had been reduced to zero, that is, once the Fed had retained earnings offsetting earlier losses, would the Fed resume remitting profits to the Treasury. Now, there's several pieces within that. And one of the big ones is they pay the Treasury. So, and given we have a deficit that is in the trillions, so we're talking about something that is maybe at most $100 billion. But this is money that's coming into the Treasury. So now if we're not paying this into the Treasury, well, that's just another avenue of value that has gone away, and it's going to take time to get it back to an avenue of value. Which just is going to mean, it just means that the Treasury is going to have less money, and they're going to have to issue more debt in order to cover expenses, because this is another revenue stream from the Fed that is going to go away, and it's going to stay away longer because, especially when you look at the sheer size of the remittance, millions of US dollars. So right now it's at about just over 12 billion. So they're losing $12 billion. And just think about the sheer size, because even at peaks, they were earning at most 4 maybe 4.5. So when you look at the earnout on that, well, this could just be another avenue of lost revenue from the Treasury, which it could have reverberating impacts just because it's going to bleed down the Treasury, coffers much faster. They're going to lose some of the abilities to do that. And this is just an interesting conundrum when you look at how the Fed balance sheet operates and the problems that it'll have in general. So then when we look at the different movements and flows, let's go left to right. So the speed of rate hikes this time is high, but not unprecedented. When you look at 1980, you had an aggressive move up. When you look at 1973 versus the current cycle, and the reason why that's so important is because in 1973, they were aggressively raising rates. But then things started to improve. And they started to reduce rates as you got into 74 and into 70, and then as you got into 75, you had a massive surge back up in inflation, which then required the moves we saw in 1980. So when you look at the problems in general, this is something that they're looking at and saying, okay, well, 1973 saw this huge increase. Then when you look at that last piece, which was 1976, it started too slow and then had to accelerate because they were so far behind the eight ball as they got into the late 70s. And now they're essentially almost taking the more conservative approach if you look at it in the backdrop of 73 and 80. And I think those 2 years matter way more for the Fed right now than other years and in other trajectories. And the goal is going to be to go up, not as fast as 1980. When you hear Volcker talk about it, he said he wishes he went up slower, but there was such a loss of faith, there was such a problem, he thought he had to go much faster. But his view was he could have stopped sooner, but held it there longer. And my view is that the Fed is going to do what Volcker wished he did, was come up fast, not as fast as we have in the past, and then stay there. Come in where, and this is why we've been saying between 5 and 5.25, and then hold. And just let that filter through, let the market adjust to what should be a normal before they start to see something, which is why we see that going through the remainder of elevated rates through all of 2023 with no cuts in the back end of it. And then this is just looking at it differently, the most aggressive Fed tightening in 40 years in terms of where it is. But that's why we want to look at 2 different pieces. Yes, it's the most aggressive in the last 40 years, but it's not as aggressive as it has been in the past. So then when we look at global PMI index, manufacturing services, this leads to what we continue to see. Manufacturing services are coming down. You're seeing the movement to the downside. Services were already there. Manufacturing is pulling down, as we discussed in Q1 in segment 1. U.S. imports have continued to come down. Chinese imports, again, kind of flatlining. And what we've been saying with China is they're just kind of here. They're just bumping along that bottom, and we don't see it getting all that much worse right away. The G7 CPI, U.S. again is leading the way higher. It's continuing to just remain elevated, and we see it going sideways, but more of a stagflation, which all leads to why we're going to see things where none of this is like this steep drop. We're contracting. I'm not saying we aren't, but there's nothing here that is telling us, wow, like things have gotten so bad, they have to adjust. No, things are doing what they should do given where the rates are and the projection of where they're going, with the U.S. 1-year forward policy rate and the G7 10-year government bond yield moving in those directions as well. But it doesn't mean that the probability of a recession in 6 months' time is now up to 90% certain. And again, certain is relative, but when you look at the data sets, how we're in contraction, how a lot of these key leading indicators, current indicators are contracting, it's giving a lot of confidence that we will see that recessionary drive. And here is the fun. The terminal overnight rate moved back up to 5%, while spreads between the 10-year and 2-year U.S. Treasury yields widened by another 3 basis points to be negative 81 basis points wide, a level of inversion not seen since October 1981. So this is, again, a lot of problems, a lot of issues when we look at where the spreads are, and this is all just an indicator of where is there a recession. Every time you've seen an inversion, there's typically a recession that it is imminently followed, which just, again, leads back to our previous chart of the certainty of an inflation of a recession coming. Number of consecutive months of monthly leading indicators, 8 consecutive monthly contractions for a leading economic index, entirely consistent with prior recessionary behavior. When you look at, we've essentially never been at this level except 2006, where this level didn't create or lead to a recession. And the CEO confidence is also showing where we expect to see a lot of these moves lower in the underlying levels. Now, when you look at financial conditions, they're kind of flatlining, and they're not really getting much tighter. They're not getting much softer. And I think that's a very interesting backdrop, again, leading to where is the Fed going to go when you look at financial conditions are kind of here. And they're obviously tighter than they were, as they should be, but not a huge hindrance at the moment, which, again, gives them more running room to continue to tighten. Number of industries reporting increases in new orders fell to 1 in November per ISM Manufacturing, smallest share since early 2009. And that is a leading indicator because, again, the increase in new orders is going down. And this is the lowest it's been. This is going back to 2001. This is the lowest it's been since 2009. Slight move higher in retail sales relative to inventories given weakness in the latter. Not enough to firmly break down the downtrend, but worth keeping an eye on. Because when you look at manufacturing, so inventories aren't moving. Retail sales relative to inventories is not really doing much. There's nothing that's going to give you the confidence. And the leading indicators on new orders is showing you that, again, industry is slowing. Industry's taking notice of the problems. Prices paid component within ISM manufacturing fell to 43 in November, lowest since May 2020, which is a positive because now that's showing a contraction, which means that prices should move down. But there's some caveats within that we're going to want to go through over the next few slides, because this is showing that slowdown in capacity, that slowdown in manufacturing, which is something that we've been seeing in general. So when we take all of this into consideration and now look at the Conference Board consumer confidence, you can see it continues to weaken. But again, the survey was for 100, came in at 100.2, but it's still falling. It's when you look at the prior week and the prior month, you continue to see the degradation, especially on expectations. Expectations have moved down again to 75.4, and we don't see a huge drop, but the disconnect between University of Michigan and Conference Board consumer confidence still continues to be vast, but all of them show a weakening in where the consumer is viewing the market. And this is just putting that into context when you look at the Conference Board and then University of Michigan in terms of where they're usually fairly close together, but they've been very broad at this point in terms of some of the different pieces. Now, we're going to talk more about retail sales in segment 3, but this is just looking at U.S. retail inventories, where they are, but then real retail inventories. And you could see that it's still below that pre-pandemic level when you look at how inflation has impacted things. And this gives you an idea of the inflation that doesn't have to be, but they're going to try to push through to the consumer, because they're going to, the question's going to be, this is what inventories are costing right now. How are we going to recoup this cost? And this is why for those that have been watching us through 2020, 2021, and obviously this year, we've been saying that inventories are expensive. And it's going to come down to who eats that expense. Are they going to be able to pass all of that down to the consumer? Is it going to be something that the company's going to have to take some of that loss? And these are the unknowns or the problems that we see when you look at those movements in prices. Again, back to the stagflation commentary. Now, weakening Capex outlook weighs on manufacturing output. And then when you look at the average regional Fed Capex intentions, it's all falling. And that's why when you look at where the indications are, this is, again, that piece of the economic footprint that is going to worsen and going to continue to worsen, as we've already seen it move into negative contraction territory. And it continues to show that in the regional Fed data and now on the national ISM level. Conference board labor differential still remaining elevated. Conference board consumers expecting incomes to decrease is going up. Now, the problem is people are expecting their incomes to fall, but when you look at inflation and you look at the rate of change, it's slowing, but it's still positive while people are expecting incomes to fall. So again, that's that stagflationary backdrop because incomes have to fall in order to reduce CPI. But then you have other pieces coming through from inventories to some of the other costs, which is why that stickiness at the stagflation is the likely case before we get disinflation, deflation. It's going to be more along the lines of a stagflationary backdrop. So then when you start looking at wage tracker, this is showing something similar. The wage tracker is starting to come down, and October jolts you saw a gradual softening of the labor market, but it's gradual. There's still a lot of openings out there, but as the openings come down, the options start to come off. Well, that means that the expectations for the wage tracker continue to deteriorate as well. So then when you look at the divergence between ISM services, blue, and manufacturing, orange prices components, the services, and this is what we've been saying, because sticky inflation was going to remain a problem. Service price is stickier than manufacturing price. Manufacturing, it's okay, well, how these raw materials have come down in price, my labor still remains elevated, but because this has come down in price, I can then pass this through and still make my margin. Services is stickier. And when you look at where service prices are for ISM, it's insanely high. It's at 70. Yes, has it come down from the highs? Sure, it's not at 85, it's at 70. It's still massively expanding at a slower rate, but still at a very rapid rate. And that is a bigger problem as we go forward. Now, the S&P Global U.S. service business activity fell into contraction. And then a quote from Chris Williamson, the one that's highlighted, the survey data are broadly consistent with the U.S. economy contracting in the fourth quarter at an annualized rate of approximately 1%. And that's where we see that momentum declining in multiple areas. But realistically, the service area is the one that's held up the best. And a lot of that is because prices are sticky. And that's where sticky inflation is from when you look at food, when you look at, and again, food falls under more on the on non-sticky, but when you look at rents and mortgages, and when you look at the underlying cost of services, those are sticky. And that is where we don't see that coming down fast enough. We don't see that adjusting fast enough. And there's a lot of that's going to stay in the system. So prices paid, you can see, remains at 70. You can see it's not at 85, but again, still well above where it is. But business activity did increase, which is a net positive when you're looking at some of these different backdrops. So now when we turn forward and we look at where the Taylor rule, and I think this is important because, again, cycling back to where is the Fed in all of this? So the Taylor rule is something that it looks at where should rates be given where inflation is, given where the economy is, and taking in some key factors. So when we look at the current cycle, the expectation is to be at 5%. Well, when you're looking at this, and this is assuming a recession, assuming different things, currently the Taylor rule says we should be at 7.5%. Do I think we get there? No, but it means that there is still enough wiggle room here to get us to 5% fairly comfortably based on the JOLTS data, based on the wage data, based on the housing data. The housing data with the prices, based on employment. and we'll talk about payrolls in the next segment, there's room to the upside. And that's, I think, a really important piece when you look at the current cycle and people are going to say, oh, this is too excessive. Well, technically it's not. And when you look at where core PCE is at that 5%, where technically it's higher, we're right on track, and we should actually be higher than we are. And that's the easing, is the difference between the two for the most part. Total quits coming down, but still elevated. Total layoffs by sector, when you can see it's still technology that is driving the show, and technology is where you had a lot of those zombie companies. So, and the quits are slowing. People are seeing the market change a bit, and they're not willing to go out there and try to get a new job in this kind of backdrop. Wage survey, therefore, is also rolling over. But there is a severe mismatch between the non-farm payroll employment and household employment, and it represents about 2 million jobs. And there is worry that when we get the benchmark revisions in early 2023, the end of 2022 monthly payroll gains get revised down. But when you look at the wage tracker in general, you're already seeing that roll over. So the question is, again, that household payroll versus the employment, it's never a one-to-one. As you can see, it waffles up and down. But typically the household side is better at catching those pivots. The question is going to be, how big is the revision? But even if they get a big revision, it's still accumulating to the point where there's a lot of lacks of ability, because the unemployment rate is currently at 3.7%. Natural unemployment is at 4.2%. So the Fed still has that wiggle room. Even with a revision, you still aren't losing enough jobs to adjust your unemployment rate to show that the Fed moved too fast. If anything, it shows that they've been doing what they're supposed to be doing at this point by raising rates. ADP's job stayers, again, job changers, all adjusting in line with things that we've been seeing. When you look at ISM services, employment index to 51.5 from 49.1, which is at odds with the downward trend in private payroll. Firms are cutting back on new hires, but we are still seeing mounting evidence that they are becoming more willing to let go of existing staff. So again, you're still seeing this friction back and forth with the non-farm payrolls, where we've seen a net change because it's still been positive, which again, is it just because there's a bit of a slack in the numbers? Is there some double counting, which happens when there's a big pivot from the household perspective, where people are between jobs, working 2 jobs? This is something that will come out over time, but it's not going to be this huge revision to be like, oh, now the Fed gets to cut. That's not what this is. And I think sometimes people try to pitch it as such, and it's not something that is showing the Fed will pivot. Supplier delivery components within both ISM Manufacturing and Services continue to show no signs of picking up, which was something that is consistent with what we've seen on a global level. But that's why when you start looking at some of the different pieces and marrying it together, household survey, establishment survey, where are we seeing some of this? So the friction as well, and when you look at housing, and the reason why we talk about that is because the other costs on the supply chain side are coming down. But you're still seeing the payment needs and the payments in general, and why they have to still pay a little more to keep and retain people, because you're still fairly flux. Is household survey right and establishment survey right? They're both probably wrong, and they meet somewhere in the middle. So you're still seeing competition, which is why wages, even though they're falling and expected to fall, they're still at an expansionary level. They're still not keeping up with inflation, which is what is keeping things up there. Now, payroll employment typically lags industry surveys, which are currently flashing more warning signals. So it's not that it's not going to get worse. It's just right now we're kind of at this steady state. But the Challenger job cut announcements were up 416% year on year in November, which is an increase, which is in line with what we're expecting, with the annual change in hiring rate, again, on the JOLT side coming down, but just back to industry norms. Like, we're not seeing this huge pivot where, oh my God, all jobs went away. It's no, job cuts are increasing. Like, there's problems out there, but the Challenger's catching up a bit. The JOLTS is catching up a bit. So it's not like we're getting this huge pivot because of this data set. Now, PCE inflation came in at 0.3%. The expectation was for 0.4%. but prior, it was at 0.3 prior. So again, holding firm. Core was at 0.2. The estimate was expected to be at 0.3. So you're still increasing at a slowing rate, but still going up. October personal income came in at 0.7 versus the estimate of 0.4. Fastest gain since October 2021, personal spending came in at 0.8 versus the estimate of 0.8. So things are fairly steady here, which is good because it's catching up a bit more to the core price adjustment when you look at inflation, but it's still negative. So net personal income is still negative. It's just not as negative as it was because it closed the gap a bit. But based on everything we've said previously, wages are starting to roll. So income will start to roll. While again, CPI, core and not, PCE is core and not, is going to remain elevated through the end of the year and into the beginning of the year, where we do see an acceleration to the downside on some of these other pieces. So then when we start looking at the personal consumption, when you look at October PCE inflation, which is that preferred method, again, year on year, 6% was expected, came in at 6%. Core was expected at 5%, came in at as expected. And we just sit sideways. Again, giving way to that stagflationary side and less about this massive drop. Factory orders were stronger in October, but as we've been saying, we expect them to weaken in November. So this is something where it's stagnating and then starting to roll to the downside, where we see additional pressure points. Now, ISM November numbers, and this is going to be important for the manufacturing side. So November ISM Manufacturing down to 49 in contractionary territory, with the expectation being 49.7. New orders dropped to 47.2. Again, a huge leading indicator that's a problem from the estimate of 48.5. Prices paid sank to 42, which is a positive when you but employment fell to 48.4, a negative, which is again back to where we see some of that meeting in the middle between the establishment as well as the household. But we did have a move up in the ISM services to 56.5 versus the estimate of 53.4. New orders and prices paid ticked down slightly. New orders, again, ticked down, still expanding, so not a terrible thing. Supplier deliveries moved lower. New export orders sank deeper into a contraction, with employment moving back to expansion. So employment moving up a bit in services, down a bit in manufacturing. Now you see what I'm saying when you look at kind of meet in the middle of the household and establishment surveys. But regardless, leading indicators in both are showing contraction, which again leads to the bigger problem that we see as we head into next year. Business activity gauge within November ISM surged to the highest since December of 2021, and we do see a reverse down in that based on those leading pieces. ISM Manufacturing new orders, giving it an example with customer inventory surging, which again is leading to less new orders because customers have the inventories that they need. So personal savings as a percent of disposable income, 12-month change in personal savings rate has not been positive since March of 2021, and it is now at the lowest level it's been since 2005. And when you look at the POP rate over year, again, that's where we see those additional drawdowns as revolving credit goes up. So again, credit card debt is surging to new all-time highs, but as a share of disposable personal income, it's rising, but not where it was previously. But that gap is closing as you have income expected to roll, as we talked about, and then the credit side continuing to surge higher. So then when we turn again to the other piece of Chicago PMI. So Chicago PMI fell to 37.2 versus the estimate of 47. Now starting to flirt with pandemic lows. Prices paid rose at a slower pace, but still rose. New orders and production fell at a faster pace and into contraction, with inventories rose at a faster pace and employment fell at a slower pace. But when you look at Chicago and what that means for ISM manufacturing, that's where it typically Chicago is a leading indicator, and that supports that drop in additional manufacturing. Dallas Fed Manufacturing Index expected to be at 21, came in at 14.4, bouncing along, but new orders, leading indicator, severely negative at 20.9 and worsening, again showing that we will get additional drops on the Dallas Fed manufacturing side. Supporting that, a drop in new orders came in at negative 19.9. Expected new orders bounced a bit, but you can still see hugging where we have been in recessionary territory. Now, when you look at number of employees, a big drop, but still expanding. Capex expectations is falling, which also means that number of employees will also likely fall, with prices paid coming down, but again, still an expansion. It's just expanding at a slower rate, with regional Fed recession indicators now massively higher. And the question is going to be, given everything else, it's been false positives, but given everything we've talked about through segment 1 and now segment 2, it seems fairly likely that is not a false negative. With Bloomberg U.S. Financial conditions, again, the Fed would like to see financial conditions tighten further, but yet they're kind of sitting here, which is why rounding it all together, we don't see them cutting rates. We don't see anything that we've shown you that shows things are getting bad to the point that the Fed's going to cut. With retail weakening, annual U.S. holiday sales adjusted for inflation are poised to fall and likely be negative, which again leads us into our conversation that we're going to have in the next segment.